Good evening and welcome to Money Matters. I'm your host, Brian Kohute from HJ Wealth Management. My co-host, Jane Scaccetti, the CEO of Drucker and Scaccetti. Our special guest, Robert Bovarnick. He's an attorney. He'll help us start up businesses. Jane, welcome.
Thank you.
We know this show is taped, so we tell people not to take advice from anything we say here, but we're kind of in the throes of tax season, so as your clients are scrambling to fund their retirement accounts, and what are you seeing out there?
I get them to call you.
Please do.
Yes,
I guess you're probably getting the Roth versus the traditional a lot, or
we get the Roth versus the traditional. At year end, maybe a little bit more than now. Now we get more about opening up SEP plans, right. Simplified employee pension plans, where they have some self-employment income. Sometimes someone will do some speaking engagements on a regular basis, or they'll have a small business or director's fees. And there's a way to shelter some of it. So we recommend that they do that. So they can do that after the year end. Right. So as we're looking at the return, there are opportunities. But yeah, it's a tax season has gotten later and later. It's almost impossible to get any return with some complexity. 1099s come out so
late anymore.
They come out late, then even after they come out late, late is, sometimes late February, early March, and then they come out corrected, and almost none of the K1s, which flow through from a lot of the investments today, are even available until the spring or the summer. So, but you still can't. You can extend the time to file your tax return, but you cannot extend the payment.
They want their money, right?
They want your money, so you must pay by April 15th at least 90% of what you ultimately will be determined that you owe, or else incur a penalty. So there's still computations and an analysis that needs to be done, and first quarter 2015 payments are due April 15th. Right, yeah. So there's a lot in a short period of time.
Yeah, and I think, as you know, clients don't understand there's not a whole lot of tax planning you can do after the end of the year. But are there deductions you see clients that just keep missing,
I think one of the biggest ones is the charitable donation of appreciated securities. And once they find out that they can donate an appreciated security, never pick up the gain as a taxable cost to them, and still get the fair market value of the donation by that. So instead of giving $10,000 in cash, they can give a security that's worth $10,000. If that has a $2,000 gain in it, that gain is never taxed. They can take the same $10,000 cash and go back and buy the same security, right. But they really get a benefit of a permanent deferral, of elimination of the capital gains tax.
Can you do that inside a private? Can you gift that to a private foundation
You
as well?
absolutely can. Now, appreciated securities that qualify as long-term capital gains property, which means that you have to hold them more than a year. But you can gift to a private foundation. The only restrictions is normally charitable donations are limited to 50% of your adjusted gross income. And adjusted gross income for most people is their total income, right, before itemized deductions. You can, if you gift to a private foundation, that limitation drops to 30%. Mm-hmm. But if you gift appreciated securities to a private foundation that you control, that drops to 20%. Okay. So you just have to make sure those limitations aren't hit. You get a carryover for 5 years if you should hit that, right, limitation. Okay. So you see a lot of people not take advantage of that. And I think there are some strategies around the investment tax, the 3.8% tax, right, that you can plan for. Even, some people will have a mortgage and they really don't need a mortgage, but they see it as a way of having enough tax deduction. Perhaps maybe convert that to an investment loan and take that as investment interest expense, and that can reduce the income that's subject to the 3.8% tax. So there's just, taxes today are not real big one idea, and
counting
it's great.
Pennies, right?
Exactly. Well, hopefully dollars,
right,
but yes, but you chip away at it, and there are small things, and you start to see that liability come down. So.
Yeah, no, it makes sense. I think, people were surprised probably last year with the new tax rate, so they've had a year to deal with it, but still.
It's still painful.
Still painful, to write the checks. So,
yeah, if you live in the city and you have city, state, and local, and you're subject to self-employment tax, and you can see a tax rate that's quick. 48% or more.
Yeah, and you're probably noticing too, because we've noticed this, given, we're 4 or 5 years into a bull market, most capital loss carryforwards have been exhausted, right?
Yeah.
So now the capital gains are starting to get taxed,
Right.
which is catching people off guard, I think, as well.
So do you also find that people are looking for strategies to take the losses when the market pulls back so that you can have some of those losses without necessarily changing what the investment strategy would be?
Psychologically, clients hate taking losses, right? And so if they're left on their own, they'll just won't. They, psychologically, they'd rather wait for a gain. Advisors like us, if we're fully diversified, we love taking losses because, to your point, we're going to use them one way or another. We'll use them.
Yeah.
So,
and if you wait till the last quarter or the last month or two, it's very difficult. But if during the year you start to harbor those losses and just hold on to them, and then as the market pulls back, you get back involved. You're not changing your investment returns, but you are impacting the amount of tax you pay.
Exactly. A lot of people wait till November to start, they call it tax loss harvesting, and you're just at the whim of what the market's doing then when you had opportunities throughout the year to take a look at it. So, and what we're seeing is some clients use mutual funds, and whether you're active, we've seen some clients that got surprised with the capital gains distributions that the fund kicked out, right? Which always rubs salt in people's wounds. Maybe the fund didn't even do that good yet. I get this big tax bill at the end of the year. So.
Yeah. Is that happening as much as it used to? I mean, before, I see now that sometimes you'll see a warning come out from the fund saying...
Yeah, they're getting pretty good to warn you in November. And same, they've been living off these capital loss carry forwards that we've all had. Even the funds got to use them, but they're starting to exhaust them. And, the more active funds have much more turnover. So we are, and we don't use a lot of active funds. So, but I see clients that hold it that, I see their capital gains. And
so you're not doing money with hedge funds. You're primarily sticking with the low cost.
We're pretty, passive, globally diversify, and let the market do its thing, and just take risk
at the
off
lowest
the table.
cost you can.
So absolutely. So, what else you seeing from a tax perspective? Any?
So, a couple of things that we're starting to see are estate planning issues. So people always felt, when the law changed and it allowed for $5 million and $5 million,
10 million,
$10 million is not a big deal, right?
So.
And for a lot of people that is true. But estate planning also has creditor protection, and it also is how do you want your assets to go to the next generation or to someone else if something happens to you. So I think people are starting to realize that there was more to estate planning than just estates taxation. And so we're seeing people revisiting that and finally looking at ways to transfer the wealth that they've worked so hard to build to their children in a fashion that will not let it be subject to creditor claims, which creditor claims are not only if you're in a accident and you have someone sue you, but that includes marital claims. And some, many people will have trusts that are pay out at age, 35, 40, and 45. And I always say to my clients, just think about a few people who are divorced and tell me at what age they are, and it's the perfect time, so you really want to protect those assets. You also want to make sure that, all of our financial affairs have gotten much more complicated. We just talked about SEPs, and we talked about IRAs, and we talked about Roths, and all these different funds that you have, and you want to make sure that you have an executor who will be sensitive to what your wishes were and what it is that you were trying to accomplish, so that they don't undo many of the strategies that you're doing.
And to your point on the multiple accounts, where you probably see most estate plans fall down is the beneficiary elections, right? They never went back and changed them, even though they have a solid will and estate plan. The titling of the assets don't match what they're trying to do over there. So.
It's often, many times I'll talk to clients and they'll tell me, no, I want all my assets to go to my spouse, and I want these assets to go to my children, and then we'll get how all their assets are titled, and all their assets are titled in joint name, which means all of them go to the spouse, right? Or the beneficiary designations aren't to the people that they thought, and their wills are just a piece of paper, They're not worth anything. So it's important to just make sure for each one of these, and when people get divorced, they don't always change their beneficiary designations on their pension plans. So there are reasons to look at what is traditionally been called estate planning, but it's really just wealth planning.
Yeah, and the other issue, the state, right? So the state
inheritance
tax is much different than the federal. So
and Pennsylvania has an inheritance tax, not an estate tax, right?
So, you have time for a question?
Sure.
All right. The question is from Martin Roberts from Philadelphia.
Okay.
We talked about IRAs. How does a stretch IRA work?
A stretch IRA is a really cool concept. I mean, it's fairly simple in design, and you probably would probably see them actually play out
Right,
more than
yep.
I do. We come up with the idea. So normally by the time you're 70 and a half, you have to start to pull from your required minimum distribution from your IRA. 70 and a half. I got the right age.
Yep.
Okay, good, thanks. If you name a beneficiary and that beneficiary after your death includes someone who's much younger, then you're able to spread that required minimum distribution, and when you pull it out, over not only your life expectancy but their life expectancy as well. So clients who have wealth where they may or may not touch the amount of money that's sitting in their IRA want to keep as much as they can in that IRA so that it can continue to grow tax deferred. And so you want to reduce the amount that you're required to pull out so you can leave more in there. So by naming the beneficiary someone who is much younger, and it could be a child and it could be a sibling, but in most cases the child, sometimes even a grandchild, you can really stretch that IRA out a generation or more.
Yeah, it can be really powerful. So
Yes.
that's a great answer. So if you have a question, here's how you send your question to Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Welcome back. So now it's time to introduce our special guest, Robert Bovarnick, of his own firm. He's an attorney, and he's going to talk about how businesses get started. So I guess the first question is, what's the best way to even hire an attorney like yourself?
Well, first of all, I appreciate the opportunity to be here to chat this afternoon. The key in hiring an attorney is you, as the client, need to understand that you control the relationship. Most attorneys, they come across as being forceful, pushy, push back. Hire them for what you need. There are a number of things that you have to realize. Let's use an easy example of litigation. You need to sue somebody, or better example is you've been sued, but you don't know how much you want to hire the attorney for. So limit the representation. Sit there and say, I'm hiring you to try to get rid of the lawsuit by filing a motion to dismiss. Say, I'm only hiring you to try to negotiate. That way, you limit what the attorney's doing. More importantly, you're limiting what your exposure is, because everybody knows that attorney fees can be very, very expensive. The second thing to remember in hiring an attorney is you want to hire an attorney to do what you need to have done. Now, you're a wealth manager, you're an accountant. I wouldn't go to you to do my taxes. I wouldn't go to you to do my wealth management. That's not your wheelhouse. That's not your specialty. Similarly, there are a lot of great attorneys that are good at what they do. And what's interesting, one of the things we're going to talk about today is some relatively straightforward concepts of forming businesses. Well, anybody theoretically can do that. In fact, you can do that yourself. You can go into Google, type in, I want to form a business, and all sorts of websites come up. There are inherent challenges with that, both if you're trying to do it on your own and if you're trying to do it with an attorney that may not know what they're doing. So one of the things that you need to know is, as the attorney, have the background in what you're looking to do.
So let's follow up on that. Rob, I think it's fascinating, the whole, the number of ways that you can operate a business, right? So you can operate a business as a partnership if you have another person that's in that business with you, a corporation, an S corporation, right? But clearly the popular choice of, today is the LLC. The
most popular choice these days still is the LLC or the limited liability company. It used to be something called the sub-S corporation. There are reasons why the LLC is better. It's easier to form. You don't have the same number of requirements. Also, anybody can be an owner of an LLC. For a subchapter S corporation, you have to be a United States citizen. But for an LLC, you can be a United States citizen, you can be a foreign national, you can be an entity, you can be a trust. It is virtually unlimited as to what you can be to be an owner of an LLC. And so that's the reason. And the reason that we do any of these things, whether it's a subchapter S corporation, an LLC, or any one of the alphabet soup of limited types of partnerships, is exactly what you were talking about a few minutes ago. What we're trying to do is we're trying to protect what we have and limit the ability of other people to get at it. In the business world, in the legal world, that's referred to as limiting your liability. And you have this corporate shield, and that's available whether it's a subchapter S, an LLC, or with virtually all types of partnerships. But I would say if you're choosing between a sub S and an LLC, the better way to go would be an LLC.
Yeah, that's our recommendation in most cases. There are some little outliers, but for the most part, the flexibility of the LLC is tremendous. You know, though I will give you something that I'd like you to expand on. So we have restaurant tours who are our clients, or we have real estate developers who are clients, and they're starting out, and we start to tell them that each one of their restaurants or each one of their rental properties should go into a separate LLC. So maybe talk to that theory.
It's a great question. There are a couple of options. One, you can set up a separate entity or a separate LLC for each restaurant, each whatever it is that you have, each hotel, each apartment building. One of the things that 9 states offer that's a variation on that theme is called a series LLC. Delaware offers it. That's the only state in this area that offers it. It's in essence the same thing, where you have in the series LLC, each entity is in what's called a cell, and you can have different members for each cell. So the way it would be set up, let's say we have Jane Holdings LLC, and underneath Jane Holdings LLC, which is the parent LLC, you can have LLC series 1, 2, 3, 4, and each of those could have a different restaurant. Now, why do we care? I'll tell you why we care. Let's say at restaurant 1, you have some type of an accident, either a slip and fall, a fire, or whatever, something that insurance doesn't cover. You want the liability to be limited to restaurant 1. So if you set it up properly, either by having totally separate LLCs, or if you properly set up the series, any liability is limited to just that one cell or that one LLC, and the person who has the claim against that first restaurant can't go after restaurants 2, 3, and 4.
Right. Or limit the liability.
It's exactly right.
Yeah.
Now,
Is that preferred? Like, a lot of times you see it in a limited partnership structure. Is that LLC preferred over that?
It is for a few. Well, it's interesting. Limited partnerships were the flavor of the month back probably in the 1980s, primarily in the single asset real estate situations. The challenge, there are a couple of challenges with a limited partnership. First, a limited partnership has to have a general partner, and the general partner is the entity that makes the management decisions. So what you have is a general partner making the day-to-day decisions, and then you have limited partners. The key to the limited partners is they have to be silent. And if they're not, in other words, they can't get involved in the management decisions. If they get involved in the management decisions, then they could be deemed to be general partners. So it becomes a little tricky. You don't have that issue with respect to an LLC. Everybody can participate in an LLC and still maintain that limited liability.
Now, you mentioned Delaware, right? So obviously we got Pennsylvania clients, we got Jersey. Is Delaware still the state of preference to start your entities?
It's interesting. Most people, when they think of, well, I've got to go to Delaware, or the other state of choice seems to be Nevada.
Right.
Now, why? There isn't necessarily a great reason. I can tell you why people think of Delaware as a state of choice is because the business court down there called the Chancery Court, they're pretty sophisticated, and they have a great understanding as to what's going on in the business world, a lot better than a lot of other courts and a lot of other states. The challenge is, if you're the lawyer, you need to know Why does Delaware make more sense? Why does Nevada make more sense? You could be putting your client at risk if you don't know the answers to those questions. So circling back around to the question we started with, which was, how do you hire a lawyer? If you're thinking about that, that's a great question to ask, which is, do you recommend a Delaware LLC? Why? And what's your experience there? Because you don't want somebody saying, oh, I read an article. That's nice, but it might put you at risk.
Right. Talk a little bit about the need for an operating agreement. As a professional, it drives me crazy when I ask someone for their operating agreement and they go, what do you mean?
It's the rules. And when I say the rules, I don't mean the rules from the standpoint of you have to have it. It's the rules as between the participants.
Right, the members.
So, yeah, in the LLC situation, it's the members and the sub-S shareholders, but it tells you what you're doing. How do you know if you don't have one? How do you know what the distributions are going to be? How do you know when you're getting money? How do you know if you have a fight between the two of you, how you're going to dissolve? If you don't have an operating agreement, then you're stuck with whatever the state statute has. So there's no reason not to have an operating agreement. It isn't that big of a deal. Every lawyer that does this they will do operating agreements. They all, in essence, start with the same basic form. And one of the things that I do, so if you were to come to me as a client, I would sit there and say, tell me what's unique about what you want to do, and we go through this checklist, and then I will take my standard form and I'll go through it, because some things, a lot of the definitions stay the same and so forth, but I need to know exactly what you want and what the other members want, and then we can have it exactly the way you want it.
Now, we all know, unfortunately, not every business makes it, right? So what happens when it's time for partners or members to part ways?
Think ahead. This is what we're talking about.
Right.
You want to have an exit strategy before you start the business. So there are a number of things to do. The most common thing that we do is we would have some type of a buy-sell, particularly if you have a situation where you have two members, and we will come up with a process by which they'll agree. And there's a multitude of ways to do it. What is the most common is you bring in somebody to provide valuation, and then the one side that wants to continue with the business, they will buy out the side that doesn't want to continue with the business. If they're not getting along that well, you could go to a court, but generally what's going to happen is a court will say, go find somebody to tell you how to get this thing dissolved. But it's crucial that you have that at the beginning. And it's better when you're still arm in arm to have an agreement as to how we're going to separate, if we're ever going to separate.
Right, you want to do that when you're still like each other, right?
Absolutely, absolutely. But one of the things that becomes interesting, you have to keep this in mind, is not everything is equal. You may have one member who has provided more of the capital. You may have one member who has provided more of the know-how. So you need to take that into account. What are the members bringing to the table, and how do we make this equal if we're trying to do an exit strategy?
Right.
So Rob, what are you seeing that's hot these days? What are people, what's the new vanilla flavor that people are excited about?
Lots of L's. And what I mean by that is we're talking really about the limited partnership. So we went from a limited partnership to a limited liability partnership to a limited liability limited partnership. And it's all geared toward the same thing. Again, we're talking about limited liability. That becomes interesting because it's another attempt to take all of the benefits of a partnership and all of the benefits of an LLC, primarily limited liability. But there's a challenge if you go into the partnership realm. The LLC world is pretty much uniform throughout the country. Not so with the partnership world. They're talking about alphabets. So you have the Uniform Partnership, the UPA, the Uniform Partnership Agreement, the Revised Uniform Partnership Agreement, the Limited Partnership Agreement, and then the Revised Limited Partnership. So, and not every state has adopted the same version. So what may happen is you decide that you're going to use a limited liability, limited partnership in Pennsylvania, and then you're doing business in Iowa. They may not believe in the same version of it that Pennsylvania does, so it becomes problematic. So again, circling back to the first question is, if you're going to do that, make sure that the person, your trusted professional, your attorney, knows what they're doing. But there are certain advantages to that, even though I'm still not quite into the limited liability, limited partnership realm. I'm still more into the LLCs. But there are circumstances where you want to go into the partnership mode.
And I would imagine, because we have this problem too, with the proliferation of businesses using the net and using the internet as a sales vehicle, people are doing business in other states and they're not even thinking that they're doing business in those other states. You know, they'll have a sale there, or they'll have a salesperson who is located there, but they're really calling on the phone, and some of these states will say that the location of the customer dictates whether or not you're doing business in that state, or the presence of an employee, even if that person is only doing it as a virtual employee. So there's different rules, and right now Amazon is, really coming up to the forefront as to what will define doing business in all these various states.
Another is eBay. I'm involved in a case right now where my client is a Pennsylvania resident. The purchaser was from another state, was dissatisfied with what was purchased, and has sued in Indiana. Our position is Indiana doesn't have the basis to have the lawsuit called jurisdiction, because our guy was never there. We have no way of knowing. If something is posted on eBay, how do you know who's looking at it? And while there's a split of authority, most of the better decisions, because it goes in favor of what I like, say that a single transaction like that will not give jurisdiction. Now, Amazon, obviously Amazon itself is a little bit different, because Amazon intentionally is selling in all 50 states. But if you're on eBay and you're having an isolated transaction, it is going to be unlikely that you get hauled into court in some foreign jurisdiction.
We have a few minutes left. If somebody has the wrong structure, is that easy to fix and unwind that, or?
Sure. Is it easy to fix? It's certainly fixable. You may have to dissolve the entity and start again. It depends on what the problem is. It may be a simple amendment to the LLC, or an amendment to the partnership agreement. Again, you need to look at specifically what the issue is and then the best fix, but anything can be fixed in that regard.
And the tax issues.
Right.
Yeah, because dissolving corporations and transferring property out of companies oftentimes carry tax implications.
And I think that's probably an important point. You really need your tax accountant and your attorney at the same table when you're making these decisions.
And that's one of the things that I always say. I will have a client come to me, and they will say, talk to me about the tax issues. And I say, you have to call your accountant, because that is not something that is my strength, and it's not my day job. Go to somebody else. Oh, I don't have to pay for somebody else. Yeah, you do.
Right.
You absolutely do. You want to protect yourself again at the beginning so that you're not harmed later on in the relationship.
Right.
Well, it's been great. So obviously, if our viewers are looking to start a business, have a business, not sure, hire a great attorney like Rob and make sure they're on the right path. So we appreciate your help with our viewers.
Thank you.
Please join us next week. Our next guest is Charles Mann. He's from Trinity Wealth Management. He's going to share some great retirement ideas with us. And as always, your money matters.